So interest rates got you down. They've been going up, they've been going down. But listen, stay tuned for some great tips on how you can save money on your interest rate. Hey, so we all know that the interest rate market is moving. If you don't know, interest rates change throughout the day. They can change 2 to 3 times a day. So even if you are checking interest rates at 9 o'clock in the morning, they're going to be different or could be different by 3 o'clock in the afternoon, either up or down. So as you're looking at homes and you're getting quotes for interest rates, make sure that you're getting accurate quotes to that time. We've all seen the news media, but you can see this post that interest rates have gone over 7%. Listen, when you go online to look at interest rates, most likely you're getting rates that are a day or 2 or even 3 days late. So they're not going to be as accurate as if you were getting a live quote for your particular loan. And each loan is going to be a little bit different depending on credit score, depending on how much of a down payment you have, depending on the loan program, depending on whether you're buying a condo or single family residence or a duplex. So keep all of those in mind because the interest rate is going to be different on each one of those. And you can't just go online and look at what one particular bank is advertising for a rate because the rates are going to be different. A couple of things that you can do actually to get a better rate is make sure that your lock period is 30 days or less. So when you're writing a contract, you don't need to write a 60-day contract. You can write it for 30 days and then get your rate locked in. And that way you're going to get the better rate because the longer you lock an interest rate, the higher those interest rates are going to go. Also, a great option is what's called a 2-1 buy down or a permanent buy down. And what that means is you have the seller paying either points or discount points in order to lower your interest rate. So as an example, on a 2-1 buy down, your interest rate, if it's say, just as an example, the going rate is 7%. The first year, your payment's going to be based off of a 5% interest rate. The second year, it would be based off of a 6% interest rate. And then in the third year, your payment's going to be based off of the 7%. Well, what that does is give you a good savings in the first and second year. And maybe by then you're going to be moving. Maybe by then you're going to be refinancing your home. So that gives you a lower interest rate in the very beginning. A permanent buy down means that the seller is going to pay points and is going to permanently lower your interest rate. So again, as an example, an interest rate may be 7%. The buyer or the seller may be able to pay to get your rate down to maybe 5.5% or 6%, something like that. So that can help you save money. The other thing, if you're putting less than 20% down on a conventional loan, as you know, you're going to be paying mortgage insurance. But what a lot of people don't know is that you can actually have the seller pay that mortgage insurance up front so you don't have that monthly fee. Depending on the loan, that could save you $100 or $200 a month just in that payment. So again, an option as you're negotiating your contract is to have the seller pay for your mortgage insurance, but you can just put that in the contract as seller paid closing costs. You'll just need to make sure that you have that proper breakdown, and you can always call me to get that. Also, the other thing, let me put on my grandpa hat right now. Listen, a lot of you need to pay off your debts. You need to set up a budget, and you need to pay off debts. Maybe putting less money down on a home is the way to go. I know I've been there, but listen, if you have outstanding credit card debt or consumer loans, it is a better idea to get those paid off and put less money down on a home. I know a lot of people, they're paying 10, 20, or 30% on credit cards, and you should not be doing that. So a lot of times, what does that mean? You've got to set up a monthly budget. If you don't know how to do that, that's something that you need to reach out. I can put some links and you can set up an easy monthly budget, but know where you're spending your money. It's always going to be better for you to look at getting a home loan and being able to buy a home rather than paying on credit card debt. Also, look at your vehicles. People are paying large monthly payments for vehicles, and that's always going to depreciate. If you buy a house over time, that house is going to go up in value, so that's going to be a better option for you. Again, look at a monthly budget. If you need help with that, give me a call, reach out to me, reach out to somebody to set up a monthly budget. So always reach out and look at a monthly budget. It's going to be a better option for you. Listen, buying a home is better than renting. Even though you may think that renting is going to be cheaper, a lot of times rent payments have gone up so much that you can buy a house that's going to be cheaper. Even if you have a $2,500 a month rent payment and you can get a $2,500 a month mortgage payment, that's going to be better because granted, you're going to be paying the bank interest on that loan, but every payment that you make is also going to go towards the principal. And basically, the principal is your money. So it's going to save you money over the long term. Over long term is going to likely go up in value. So you're always going to be building that equity. And again, if the interest rate is higher than what you had expected right now, in time with better credit and more equity in your home, you're going to get a better interest rate. So if you have any questions, please feel free to reach out to me. Marry the home, date the rate, so you can get the home of your dreams now. There's more homes on the market, so it's a great opportunity for you to get out there and purchase your first home.